Imagine walking through the busy streets of Shanghai on a Monday morning. Office workers are rushing to work, students are hurrying to class, and almost everyone is holding the same coffee cup, not from Starbucks, but from a company that barely existed a few years earlier. Its name was Luckin Coffee. To millions of people, Luckin represented the future. A modern coffee company built entirely around smartphones, fast delivery, and affordable prices. There were no long lines, no expensive cafes, no waiting. Just open the app, order your coffee, and pick it up within minutes. The idea was simple, but the growth was unbelievable. Stores appeared almost overnight. One city became 10, 10 became 50, then hundreds. Before anyone realized what was happening, Luckin Coffee had become one of the fastest-growing companies in the world. Investors couldn't believe the numbers. Every financial report looked stronger than the last. Revenue seemed to be exploding. Customers appeared to be everywhere, and Wall Street was convinced it had discovered China's answer to Starbucks. Money poured in. Venture capital firms invested hundreds of millions of dollars. International investors rushed to buy shares. Business magazines praised the company's innovation. Financial analysts called it one of the most exciting startups in Asia. Everything seemed perfect. Then, the company made an announcement that changed everything. In May 2019, Luckin Coffee officially went public on the NASDAQ stock exchange. It was one of the biggest IPOs of the year. Investors celebrated. The company's valuation climbed into the billions. Its founders became some of the most talked about entrepreneurs in China. From the outside, Luckin looked unstoppable. Thousands of stores, millions of customers, billions in market value, and a mission to defeat Starbucks in the world's largest consumer market. It sounded like the perfect business story, but behind the polished presentations, behind the impressive investor reports, and behind the incredible growth, a very different story was unfolding. One that almost nobody could see, because somewhere inside the company, someone had started asking questions. Questions about sales, questions about receipts, questions about numbers that didn't seem to make sense. At first, nobody listened. The company was growing too fast. The headlines were too positive. The excitement was simply too powerful. But the truth has a strange habit. No matter how deeply it's buried, it eventually finds its way to the surface. And when that happened, Luckin Coffee didn't just lose money. It lost something far more valuable: trust. To understand how one of the world's fastest-growing startups reached this point, we need to go back to where the story really began. Not on Wall Street, not on NASDAQ, but in China, where a bold idea promised to change the way millions of people drank coffee forever. Back in 2017, China was changing faster than almost any country on Earth. Its economy was booming. Technology companies were transforming everyday life. And smartphones had become the center of everything. People ordered food, booked taxis, paid bills, even bought groceries, all from a single mobile app. Yet one industry remained surprisingly underdeveloped: coffee. Compared to the United States, China's coffee consumption was still remarkably low. Most people preferred tea. Coffee was often seen as expensive, foreign, or simply unnecessary. But younger professionals thought differently. They wanted speed, convenience, modern lifestyles, and coffee fit perfectly into that new way of living. One company noticed this opportunity before almost everyone else: Luckin Coffee. Instead of copying Starbucks completely, Luckin decided to build something different. The founders asked a simple question: what if we remove everything customers don't really need? No comfortable sofas, no large cafes, no long conversations over coffee. Instead, fast pickup, fast delivery, lower prices, everything controlled through a mobile application. It wasn't just a coffee company, it was a technology company that happened to sell coffee, or at least, that's what investors were told. Every customer downloaded the Luckin app. Orders were placed digitally. Payments happened instantly. The company collected valuable customer data with every purchase. This allowed Luckin to launch personalized discounts, targeted promotions, and loyalty rewards at an incredible scale. The strategy worked. Customers loved the convenience. Students loved the discounts. Office workers loved the speed. Within months, Stores began appearing across Beijing, Shanghai, Shenzhen, Guangzhou, and dozens of other cities. Expansion became the company's obsession, while traditional coffee chains carefully selected new locations. Luckin opened stores almost everywhere: office buildings, shopping centers, universities, business districts, residential neighborhoods. If there was enough demand, Luckin wanted to be there. Construction teams worked day and night. New employees were hired every week. Marketing campaigns flooded social media. Free coffee coupons spread across mobile apps. It felt impossible to ignore. Then something remarkable happened. People who had never been regular coffee drinkers started buying coffee almost every day. Not because they suddenly loved coffee, but because it had become affordable, fast, and incredibly convenient. Investors noticed the explosive growth. Revenue reports looked impressive. Store numbers kept increasing. Media headlines became even more optimistic. Some analysts predicted that Luckin could eventually overtake Starbucks in China. It was an extraordinary claim, but during those early years, it didn't seem impossible. Money started flowing into the company at an astonishing pace. Some of the world's biggest investment firms wanted a piece of the business. Every funding round valued Luckin higher than the last. Each new investment strengthened the belief that China had finally produced a true global coffee challenger. Inside the company, confidence reached extraordinary levels. Executives believed they weren't simply building another cafe chain. They believed they were creating the future of retail. Technology, artificial intelligence, big data, mobile commerce. Everything became part of the company's public image. But rapid growth often creates dangerous pressure. The market expected bigger numbers every quarter. More stores, more customers, more revenue, more success. Missing expectations wasn't an option, because in the startup world, growth attracts investment, but slowing growth can destroy confidence almost overnight. As the company expanded faster and faster, very few people stopped to ask one important question. Were all these incredible numbers actually real? At first, nobody wanted to know the answer, because the dream was simply too exciting. But hidden behind thousands of coffee cups, millions of mobile orders, and billions of dollars in investor money, a dangerous secret was quietly growing, one that would soon become impossible to hide. By 2018, Luckin Coffee was no longer just a startup. It had become a phenomenon. Every week seemed to bring another announcement, another funding round, another expansion plan, another record broken. The company's growth appeared almost unbelievable. Stores were opening at a pace rarely seen in the restaurant industry. In less than 2 years, Luckin had built thousands of locations across China. Even industry veterans were stunned. The comparison with Starbucks became unavoidable. For decades, Starbucks had dominated the global coffee business. Its brand was recognized almost everywhere. Its stores represented premium coffee culture. Its growth story inspired entrepreneurs around the world. But now, a young Chinese startup was openly challenging that empire. And according to some reports, Luckin was opening stores faster than Starbucks. The media loved the story. Investors loved it even more. Every great investment story needs a narrative. And Luckin had the perfect one. A technology-driven company, a massive untapped market, a rapidly growing middle class, and a direct challenge to one of the world's most iconic brands. The timing couldn't have been better. Investors around the world were searching for the next billion-dollar success story. Technology companies were receiving enormous valuations. Growth mattered more than profits. Expansion mattered more than stability. And Luckin seemed to have both growth and expansion in abundance. Then came 2019, the year that changed everything. In May 2019, Luckin Coffee officially went public on the NASDAQ stock exchange. The IPO attracted tremendous attention. Investors rushed to participate. Financial media covered every detail. Analysts praised the company's potential. And Wall Street welcomed Luckin as one of the most exciting growth companies in the market. The stock performed strongly. The company's market value surged. Within months, billions of dollars had been added to its valuation. The future appeared brighter than ever. Inside corporate headquarters, executives celebrated. Employees celebrated. Investors celebrated. The company had achieved what many startups only dream about: a successful public listing, global recognition, and access to enormous amounts of capital. But success can sometimes create its own problems. Because once a company becomes public, the pressure changes. Private investors are often willing to believe a vision. Public investors demand results. Quarter after quarter, year after year, the expectations never stop. Luckin now faced enormous pressure to keep growing. Revenue had to increase. Store counts had to rise. Customer numbers had to expand. Every earnings report needed to look stronger than the last. Anything less could damage investor confidence. At first, the company appeared to meet those expectations. Revenue growth looked extraordinary. Customer activity seemed impressive. Store expansion continued at an incredible speed. Everything looked perfect, perhaps a little too perfect. Because somewhere outside the company, a group of analysts had started paying attention, and they weren't convinced. The numbers looked unusual. Some growth rates appeared almost impossible. Certain financial reports raised questions. Some analysts began comparing public claims with real-world observations, and what they found didn't always match. Still, most investors ignored the warnings. After all, the stock was performing well. The company was growing rapidly, and nobody wanted to miss the next big success story. This is something that happens repeatedly throughout financial history. When people become excited enough, they stop asking difficult questions. They focus on potential. They focus on future possibilities. And they assume someone else has already checked the details. Meanwhile, Luckin's leadership continued promoting its vision. The company spoke confidently about expansion. More stores, more cities, more customers, more growth. The dream kept getting bigger, and so did investor expectations. Then one day, a mysterious report appeared. At first, almost nobody noticed. It wasn't released by a government agency. It wasn't released by a major bank. It wasn't released by a famous investment firm. Instead, it came from anonymous researchers, people whose identities remained hidden, people who claimed they had spent months investigating Luckin Coffee. Their report contained a shocking allegation. They believed Luckin was inflating its numbers, artificially boosting sales, misrepresenting growth, and misleading investors. The accusations were explosive. If true, they would destroy the company's credibility. If false, they could be dismissed as market rumors. Luckin immediately denied the allegations. Executives insisted the business was legitimate. Supporters defended the company. Many investors continued buying shares. But the anonymous investigators weren't finished. They claimed to possess evidence. Not opinions, not guesses. Evidence. Thousands of hours of surveillance, store observations, customer tracking, transaction analysis, receipt verification, data collection on a massive scale. According to the report, something inside Luckin Coffee wasn't adding up, and the deeper investigators looked, the more troubling the situation became. Wall Street suddenly faced a terrifying possibility. What if one of its fastest-growing companies wasn't growing the way investors believed? What if the numbers driving billions of dollars in market value were partially fictional? At first, the market remained uncertain. Nobody knew who to believe, the company or the investigators. But soon, the evidence would become impossible to ignore. And when the truth finally emerged, Luckin Coffee's spectacular rise would transform into one of the most shocking corporate scandals of the decade. For months, Luckin Coffee insisted that everything was under control. The company dismissed the allegations. Executives called the accusations misleading. Investors were told to remain confident. And for a short time, many of them did. But behind closed doors, the pressure was becoming impossible to ignore. Lawyers were reviewing documents. Senior executives were holding emergency meetings. Board members demanded answers. And every hour brought another difficult question. Could the allegations actually be true? The investigation continued. Researchers compared millions of receipts. Store traffic was analyzed. Customer transactions were reviewed. Employee interviews revealed troubling inconsistencies. Slowly, a disturbing picture began to emerge. Some sales appeared to have been artificially created. Certain transactions couldn't be verified. Revenue figures seemed far higher than the actual business activity. The numbers that had impressed Wall Street were beginning to fall apart. Then came the moment that changed everything. In April 2020, Luckin Coffee shocked the financial world. The company announced that an internal investigation had found evidence of fabricated transactions. Not thousands of dollars, not millions, hundreds of millions of dollars. Approximately $300 million in reported sales had been fabricated. The company admitted that employees had created fake transactions to inflate revenue. Wall Street reacted instantly. Investors rushed to sell. Within hours, Luckin Coffee's stock collapsed. Billions of dollars in market value disappeared. The company that had once been celebrated as China's fastest-growing coffee chain suddenly became one of the biggest corporate scandals in recent history. For shareholders, the losses were devastating. Some had invested their retirement savings. Others believed they had found the next Starbucks. Instead, they watched their investments lose most of their value in a matter of days. The scandal quickly spread beyond investors. Financial regulators launched investigations. The U.S. Securities and Exchange Commission began examining the company's disclosures. Chinese authorities also opened investigations into the fraud. What had started as an anonymous research report had now become an international corporate scandal. Inside Luckin Coffee, the consequences were immediate. Several senior executives were suspended. The company's chief executive officer was removed. Other top managers were dismissed. The leadership team that had promised unstoppable growth was suddenly fighting for survival. Employees were left in uncertainty. Many had joined the company believing they were building one of China's greatest business success stories. Now they faced public criticism, media attention, and questions about the company's future. Some stores remained busy. Customers still bought coffee, but the company's reputation had been severely damaged. For Wall Street, the scandal became another painful reminder. Fast growth can be exciting, but extraordinary claims require extraordinary evidence. Investors had focused on expansion, store openings, customer growth, valuation. Few had questioned whether the underlying numbers were accurate. The Luckin Coffee scandal also exposed another uncomfortable truth. Modern startups often depend on one thing above everything else: confidence. As long as investors believe the story, money continues flowing, growth continues, valuations rise. But once trust disappears, everything can collapse with astonishing speed. Financial newspapers around the world featured the story on their front pages. Television networks covered the scandal for weeks. Business schools added Luckin Coffee to their case studies. The company had become a global example of what can happen when rapid growth is placed above transparency. Despite the scandal, one important question remained unanswered. Would Luckin Coffee disappear forever? Or could the company somehow survive one of the biggest corporate fraud scandals of the decade? The answer surprised almost everyone. Because unlike many companies destroyed by fraud, Luckin Coffee wasn't finished. Its most unexpected chapter was still ahead. The confession changed everything. Within days, Luckin Coffee had gone from being one of Wall Street's brightest success stories to becoming one of its biggest embarrassments. The company's stock price collapsed. Billions of dollars in market value disappeared, and investors around the world were left asking the same question. How could this happen? For the NASDAQ stock exchange, the answer was simple. A company that had admitted fabricating hundreds of millions of dollars in sales could no longer remain listed. In June 2020, Luckin Coffee was officially delisted from NASDAQ. It was a dramatic fall. Just 1 year earlier, the company had proudly celebrated its arrival on Wall Street. Now, it was being removed from one of the world's most prestigious stock exchanges. The legal consequences soon followed. Regulators in both the United States and China launched investigations. The U.S. Securities and Exchange Commission, better known as the SEC, accused the company of misleading investors by reporting false financial information. Luckin Coffee eventually agreed to pay a $180 million settlement to resolve SEC charges, without admitting or denying the allegations. The financial damage was enormous. But the damage to the company's reputation was even greater. Around the world, business schools began studying the scandal. Corporate governance experts analyzed every mistake. Investors asked difficult questions. How had so many experienced professionals failed to detect the fraud? Why did so many people trust the numbers without demanding stronger evidence? And perhaps the most important question of all, had the pressure to grow at any cost created an environment where fraud became almost inevitable? Inside the company, everything changed. A new management team took control. Executives responsible for the scandal were removed. Internal controls became stricter. Financial reporting was strengthened. The company focused on rebuilding trust, one step at a time. Surprisingly, customers never completely abandoned Luckin Coffee. Many people continued buying coffee. For them, the scandal was about executives, not about the quality of the drinks. Store operations continued. New management concentrated on profitability instead of rapid expansion. For the first time, Luckin Coffee began focusing on building a healthier business. Over the following years, something unexpected happened. The company slowly recovered. Sales improved. Operations became more stable. Many stores remained profitable. Although the scandal would never be forgotten, Luckin Coffee proved that a company can survive, even after one of the biggest corporate fraud scandals in modern history. But surviving is not the same as escaping history. Today, Luckin Coffee is remembered for two very different reasons. The first, its extraordinary growth. The second, its extraordinary deception. Together, they created one of the most remarkable business stories of the 21st century. The Luckin Coffee scandal teaches us several important lessons. The first lesson, rapid growth should never replace transparency. A company can open thousands of stores, generate billions in revenue, and still hide serious problems beneath the surface. The second lesson, investors should never fall in love with a story. Great presentations, charismatic executives, and exciting headlines can never replace careful financial analysis. Numbers must always be verified, especially when they seem too good to be true. The third lesson, corporate governance matters. Strong internal controls, independent oversight, and honest financial reporting protect not only investors, but the company itself. Without accountability, even the fastest-growing businesses can collapse overnight. Finally, Luckin Coffee reminds us of a timeless truth. Trust takes years to build, but only moments to lose. In business, reputation is often more valuable than revenue, because once confidence disappears, winning it back is one of the hardest challenges any company will ever face. As for Wall Street, the scandal left a lasting mark. Investors became more cautious. Analysts looked deeper into financial reports, and regulators increased their scrutiny of fast-growing companies. Luckin Coffee changed the way many people evaluated high-growth businesses. Its legacy extends far beyond coffee. It became a warning to every entrepreneur, every investor, and every public company. So the next time you hear about a startup growing faster than anyone imagined, ask yourself one simple question. Is the business truly exceptional? Or is the story simply too good to be true? Sometimes, the biggest risks are hidden behind the biggest success stories. Thank you for watching. If you enjoyed this documentary and want to discover more stories about billion-dollar frauds, corporate collapses, startup failures, and the biggest financial scandals in history, subscribe to Money Trap, turn on notifications, and join us for our next investigation. Because in the world of business, every billion-dollar success has a story, but not every story is built on the truth. See you in the next documentary.